Good afternoon, everyone. It's Paul and Katy from Vincents Chartered Accountants here. Welcome to this webinar. Now, for astute viewers and listeners out there, you can see that we've got a Lego movie theme. So Katy will be Wild Style today. I will be Emmett. The good thing is Emmett's got a little bit more hair than me. So not quite sure whether everything is awesome given some of the decisions in the budget. But we'll keep that theme today, and hopefully we can run through some things and talk about year-end tax planning and maybe talk a little bit about how the budget might affect some of the things. Now, one of the things we want to talk about is the interaction of year-end tax planning with the May federal budget. And the issue is a lot of the announcements in the budget are not yet law. Some of them may never be law, depending on whether the bill gets passed before the 30th of June or whether it's carried over into the new financial year. And we need to be very careful in making decisions on what is an announcement and is not law, or what ends up in a vastly different format after the Senate has finished with it. So we'll just talk about that a little bit as we go through today. Other point is 30th of June 2014 falls on a Monday this year, so generally if you need payments or amounts to come out of bank accounts or be received into bank accounts, it's really got to happen by the 27th. So just keep that in your diary in terms of talking to clients. If you ring them up on the 29th of June, you're not going to pay many things on a Sunday afternoon, unfortunately. The other comment we make is tax planning should be continuous. So we talk about it this time of the year because clients are getting fairly close to June, but really it's something that we should be looking at on an ongoing basis, not just a flurry of activity right at the end of the year. So now might be a good time to diarise some time once you get through the year end with your clients, if there's other things to be done that can be looked at in the new year. Now, most pre-30th of June planning is a short-term solution, and we look at the 3 points we've got on this slide here where we're talking about to defer the derivation of assessable income, bring forward allowable deductions and look at available offsets. Now, a lot of those decisions are timing based, so it's whether things are going to be incurred now or later and the cash flow effect of those. And your real tax planning is more of a structural decision. What entity structure you're using depending on your business and where you are in the business life cycle, and what sort of activities that you're undertaking. So you can almost say that what we're looking at doing now is more of a band-aid to try and get us through the current year's income and expenses and what it all means and the resulting tax liability. But for looking at what we're going to be doing on an ongoing basis, we need to revisit as a result of that what structural decisions we need to make based on what our business is doing. Now, these are some things to consider. So the whole point of today is to try and maybe raise some questions with the accountants and lawyers out there so they can then go and talk to their clients and consider some things that will be relevant to their circumstances. So you can use this as a little bit of a checklist. Can income be concessionally taxed? And that might mean if you've got income on revenue account or capital account, depending on the nature of the entity and the activities that are being undertaken. And when we say concessionally taxed, if something's on capital gains tax account and the asset's been held for more than 12 months, there may be a 50% discount on the CGT liability, or it's in a self-managed superannuation fund, the rate of tax might be reduced from 15% to 10%. So that's something to think about. Also from a GST point of view, depending on the supply, might be medical or adult education, which is GST free. That has an impact on the business in terms of what they're doing. Similarly, can the income be received in a structure that is concessionally taxed? And one of the challenges there is that you can't get the 50% discount in a company structure if it holds appreciating assets. So you can do all the wonderful tax planning things, and as we said in the previous slide, if the structure isn't appropriate, there's not a lot you can do about it if that is the situation that you're in. The other thing we sort of look on a general basis is timing of deductions. Generally, we're on an accruals basis, so whenever we incur an expense, that's when it's deductible for businesses. If you've got individuals in their own right, it's when they pay an expense. So those things need to be considered as to what that might mean for particular client circumstances. Deductions also to treatment of non-deductible amounts and what that might mean and how that may affect if you've got trusts or something and accounting profit and taxable profit, what that means flowing through that particular structure. So there we are looking back to the structure you've got in place and what that might mean. Now, just going in a little bit more detail in particular areas, like if you're in business and the income and the basis for returning assessable income. And we have the old accounting challenge of cash basis, or when the money's received versus accruals. And then we also have the concession for a small business entity, generally where the turnover is less than $2 million, where you can account for your GST on a cash basis rather than an accruals basis. There's also a little bit of confusion where practitioners might think, well, just because a client's accounting for GST on a cash basis, so when they pay an expense or receive income, that's when it's recorded in their BAS and then paid, they can then account for their income and expenses in the business on a cash basis. And that's not so. So that needs to be considered carefully, because some clients might be running cash-based profit and losses in their accounting software to calculate their GST, and they've got their cash-based profit or loss in their mind. The accruals-based profit or loss may be vastly different. So that's something to think about and talk to your clients about. Deferring income, the same thing in terms of when you've got an actionable debt or you finish whatever you have to do in the delivering the goods or providing the services, when you can return it as income. Also looking at what your customer needs are. So it's all well and good to say, well, we haven't got any work, we can finish in the last week of June, but if your customers need their product or they need to spend their money because of their budget or whatever else, that's a more commercial consideration as opposed to a tax-driven consideration. Same as accelerating income. Some organisations, if you've got people who are getting bonuses or performance-based things that they're required to sell a certain amount of product or finish a certain amount of things by a deadline, or they're reporting to a parent company or a board or whatever else, that may be a commercial decision on why they want to do something as opposed to rather the tax planning point of it as well. So that's something to think about, what your specific client's needs would be. Now, income for services not yet provided, generally you wouldn't be returning those as income because you don't have an actionable debt that you can pursue someone over because you actually haven't done what you've agreed to do. But similarly as well, on the other side, clients may be wishing to prepay for things, to purchase consumables and things that we'll talk about later, so that may be relevant. We have the sort of three broad categories of other income: dividend income, interest income and trust distributions. It's generally, trust distributions, it's the year the distribution is made, even though you may not receive the distribution until future years, it's still got to be returned as income. Your dividend and interest income, it's when it's earned on your shares or your term deposits and whatever else in the business. So it's just a checklist to talk to your clients and just think about what it might mean in their circumstances. And another point is, if we've got assets that are subject to capital gains tax system, I'm sure all of the accountants out there, if they had $1 for every time their clients have said, look, I've just signed a contract to sell my block of land, but I don't have to pay any tax because it doesn't settle until the 5th of July, even though I signed the contract on the 29th of June, the date of the contract is relevant, not the settlement date. So using that example, if you sign the contract on the 29th of June, you've got to then return that gain in your current year's income, whereas deferring in a couple of days means you get another year's extension in terms of the taxable income in the year that it falls into. Similarly, be mindful with the assets held for 12 months or more, where you get the 50% CGT discount, and that's only available to individuals and trusts include superannuation funds where it's not a 50% discount. But same issue, some clients under the apprehension, if they've got companies that have got appreciating assets and they somehow think the 50% CGT discount may apply, they might be in for a little bit of a shock. So the advice is with clients, a 2-minute phone call talking about selling some shares or selling some real estate or an asset might save them a lot of pain and cash flow negative benefit in the future by talking to you, rather than just going and doing something and then telling you they've done it later on when they bring all their books and records in. Similar thing with businesses that have got trading stock, and the valuation purposes for taxation purposes, and depending on if you've got stock that it's obsolete or it's very seasonal, that your $500 designer boots this year are not in fashion anymore, therefore they're not going to be worth that when you're selling them this year. Or similarly, if you've got obsolete stock and looking at what that might mean if it hasn't moved for 12 months, or if there's stuff down the back of the warehouse or the shop that no one really sort of knows about, but it's still in the books, you want to look at what that is and make sure that you've recorded that before 30th of June in the business. The other one you might have is if you've got timing and volume rebates and other incentives, incentives, where you may be getting a discount based on the amount of product you purchase from a supplier, but you wouldn't know what the amount would be until they calculate that after 30th of June. So the same thing there, if you have a step incentives where if you get a bigger discount by purchasing above a certain volume, that might be worthwhile looking at that before 30th of June to see whether that's going to be relevant in terms of calculating any benefits you might get. Another one as well is if you've got the sale of land, and where you have the situation where you're subdividing or you're breaking it up to get blocks of land to be sold, until those blocks settle and you've got an actual debt over someone to pay you for it, it's not regarded as assessable income, and sometimes people can get a little bit confused on that and think, well, I've got a pre-sale contract before 30th of June, I have to pay tax on it. Now, moving on to deductions, and it's the same thing, thinking about your client, having a look at their profit and loss, and having a look at their aged debtors and receivables. There's no point, if you're on an accruals basis, in other words, you're paying tax on your income when it's invoiced, not when it's received, that if you've got a debtor in there that owes you money, they're out of terms, you've been trying to negotiate to get them to pay, you really need to sit down before 30th of June and resolve to write that off. Also amend the BAS if there's been any GST remitted on that. Often clients forget to do that. And if you continue with the legal process and you recover that money in the following financial year, it will obviously be returned as income, as a bad debt recovered. But I think it sort of requires a sitting down and a formal meeting with the owners of the business to do that before 30th of June. Bonuses, you may have arrangements clients will have with their staff. The same thing, resolving to pay bonuses based on whatever performance they've been required to measure against. The same thing, if there's a resolution and they're committed to pay that in the business, that'll be a deduction. But if the employee doesn't receive it till the following financial year, they're on a cash basis, they don't return it in their income tax return. One that we see a lot of problems with is the superannuation contributions. We're under the SGC legislation, you've got to pay your contributions within 28 days at the end of the quarter so as to not get caught up in the superannuation guarantee charge. However, though, to get a deduction, the contributions must come out of the employer's bank account before 30th of June. And going back to the original slide I was talking about, so that's really the 27th of June to be sure that that's come out. And we see lots of clients who have their superannuation contributions for the last quarter or the last month in trade creditors, and unfortunately they're not a tax deduction. Now, another point which relates to the budget, where we had the provisions where you have the special $5,000 motor vehicle write-off and the $6,500 plant and equipment write-off provision for a small business entity. When the Liberals came in and wanted to repeal the carbon tax bill, that legislation was attached to that. That bill didn't get through, so we're in a sort of a limbo land now where from 1 January 2014 we revert back to the old $1,000 limit for writing off plant and equipment. Now, who would know? Maybe Mr Palmer, when he's in the Senate on 1 July, will jump out of bed one day and decide to pass it, or he may do something else. So from being a prudent advisor, I think it's safe to advise your clients to only claim that $1,000 limit per item, and if we do get a good break and the $6,500 limit's reinstated, then we go back and amend returns if we have to. but that's an example of we're not quite sure where the situation is going to end up because it's sort of paired together with that carbon tax bill. One of the things very important is get clients to review their, or if you're an accountant, you've prepared their plant and equipment register, and physically go around and scrap any plant equipment that is broken and no longer working or has gone or been traded in or something. We see plenty of clients that have got computers from 1993 still sitting in the depreciation schedule, or if they've got printers and things or stuff that no one does a physical check against them, and if they're not there, write that off. The other thing we see as well is if you have consumables in your business, regardless of whether it's welding rods and protective clothing or printer stuff, look at purchasing that before 30th of June 2014 so you can get a deduction for that in the business. No point going into Officeworks on the 1st of July and buying a whole pile of stuff because you don't get the deduction in that particular year. That relates back to my comments earlier where you may have businesses who they know that this is a good time of the year for everyone to spend their budget or to purchase things, so there's often promotions and discounts that you can get in terms of buying stuff before 30th of June. Now the caution from a business management and a cash flow point of view, there's no point committing to buy a whole lot of extra equipment because it's cheaper if you sell equipment if your overdraft can't sustain it. So you've probably got to be a bit mindful of the tax deduction and make sure you can run your business prudently within whatever finance facilities you have. Now, the statutory obligations as a deduction for business as well. I've talked a little bit about the superannuation guarantee contributions. The other tricky area is, I've used the inverted commas around contractors there, depending on whether you're, as an employer, of the opinion that someone's a contractor or whether the ATO thinks they're an employee. That can be quite relevant in terms of whether you're required to pay the contributions on that. That's something to think about before 30th of June rather than after the year end. If there's some people in there who are contractors, you really need to look at and get the superannuation paid now rather than being at risk of getting caught up with a dispute with the ATO later on. Now, as of yesterday afternoon, the SuperStream requirements, which was going to have the ATO gateway for employers with 20 or more employees, that's now been deferred from 1 July 2015, so I've been given an extra year's breathing space on that, which is probably a good thing. Electronic lodgement of business activity statements from the 1st of July 2014. If you lodge on paper and continue to lodge on paper, the ATO will send you a paper copy out. If you lodge electronically, they won't send any more paper copies out, so they're really moving towards an electronic system. Instead of sending the paper copy, they'll send you an email to your nominated or your client's nominated email address saying that your BAS is ready to be downloaded. So that's something that we'll have to think about with some of the clients who post their paper copy into the tax agent, and the tax agent lodges it by ELS. There might be a few problems with that along the way. And a final thing on statutory obligations is payroll tax. So very generally in Queensland, if you pay wages of $1 million or more, and wages may include the OSR's definition of contractors, there's a potential payroll tax liability. Similarly, if you pay less than that, if you've got employees in other states around Australia, there may well be an obligation. So it's probably worthwhile looking at your client's profit and loss and looking at their level of wages and looking at their payments to contractors, and on a worst case basis, are they potentially caught? Because the OSR is becoming very aggressive in collecting revenue in that area.
If I can just make a point too, Paul, on contractors, just bearing in mind from work cover perspective, there's been quite a number of audits done around that, and with respect to contractors, there's been, just need to be mindful that your clients are aware that the work cover premiums are paid on their wages as well as superannuation guarantee. And there is some potential work cover for contractors. So you just need to make sure that they're aware of that and making sure that everybody is covered accordingly.
Yeah, good one, Katy. So those are the things that in just looking at your client's profit and loss for the year to date, it's something to look at and alert yourself to now rather than in the months after 30th of June when the clients bring their information in. Now, on the other statutory obligations, with the fringe benefits tax rate increase from the 1st of April 2014 to 47%, which will then change the gross up. Now, one of the risks, without going into great detail, one of the risks we've got is to make sure that if you've got salary sacrifice arrangements with employees that may have been calculated on the old FBT rate, we need to make sure that those adjustments are made so that we're not undercharging or under-collecting amounts, because some people may have their salary sacrifice arrangements written in specific numbers rather than allowing for any increase or change in the FBT rate. Now, with the budget announcements, and assuming that they all do go through as legislation, there's a lot of the changes don't come into the 1st of July 2015. So in theory, there's a 1 year of planning opportunity to look at those things. But I think the greater risk is just to make sure that we're collecting everything correctly and we're not over or undercharging employees in that area. Now, I'll hand over to Katy, and she's going to talk about some of the other more specific things in companies and trusts.
Okay, so one of the main issues that we find as advisors is when basically shareholders or associates pull money out of the company. So we've got a loan to the shareholders and associates sitting on the books of the company. So they need to be dealt with in the appropriate manner, because there's implications obviously that occur with respect to that. There's probably the 3 types of loans that you'll probably see within the company's books. So, and you'll need to quarantine or separate them accordingly. So with the first screen here, we're talking about loans that were implemented prior to 4 December 1997. So I would suggest making sure that they're quarantined on your balance sheet, but looking to make sure that those loans haven't been altered in any way. So making sure that the amounts and the terms of those loans haven't changed. It might be prudent to get actually the debtor or the associate or shareholder to make some form of payment just to ensure that basically the loan can't be forgiven or it's statute barred. So even an acknowledgement that they're acknowledging that the loan is still in place, that might be a good thing to obtain from the debtor. Just covers you off and knows, otherwise the term of the loan could change. With respect to the loans then made in this current financial year that we're in, we find that a lot of clients and bookkeepers are doing accounts and mild that there's a lot of loans set up during the year for the same borrower. So it's prudent that you try and get all of those together and combine them into one if it's the one shareholder. Now, making sure though that you don't combine the current year's loans with prior year loans as well. So you want to separate them out on the balance sheet to make sure that they're completely separate. With loans made in this current financial year, make sure that there's a loan agreement in place, ensuring that the correct benchmark interest rate and everything is stipulated within that. Now, that has to be done prior to lodgement of the 014 tax return. However, with those loans, your first repayment isn't generally until the next financial year. So as long as that's made prior to 30th of June 2015, that is not a problem. However, with respect to the loans that you've made in the prior financial year, and we can talk about 30th of June 13 or ones prior to that as well, you need to make sure that your clients are making a minimum repayment on those loans. And ensuring that you're using the correct benchmark interest rate, because that has changed over the years, so making sure that that's right and calculated correctly so they're not paying too much in interest or too little. But if you don't pay that minimum repayment in cash, you need to make, you can either utilise a payment of a dividend, I suppose, to the shareholder. If you do go down that path though, just make sure that there's documented evidence to support that that's what you were doing and making a payment to offset that minimum repayment. Now, there's obviously huge issues though if you don't make that minimum repayment. So it could be a deemed dividend and you do not want to go down that path. There's consequences associated with doing so. So just ensuring that those are made prior to the end of this financial year. Now, just back on a couple of those points earlier as well. When you're looking at setting up and doing the loan agreements, making sure that you just look at the terms. So whether you put the loan agreement over a 7-year term or a 25-year term, you need to think about in the best interest of your clients. The 25-year term, though, however, must be secured. 100% of it must be secured over a property. So bearing that in mind, there is options, and it's not only limited to the 7 years. So have a look at those things. So if you've got an unpaid present entitlement, so within a company, so this is where trusts have distributed, as you say, to a bucket company or something like that over the years. And generally they're put on the balance sheet as an unpaid present entitlement. You need to make sure that it is still classified as an unpaid present entitlement. So it could, in the terms of the deed, actually be saying that it's a loan and not an unpaid present entitlement. So you need to reflect that accordingly within the balance sheet of the company and dealing with that. If it converts to a loan, well, that will mean that Division 7A will then apply and minimum repayments, etc., loan agreements need to be undertaken in respect of that. So just bear that in mind and have a look at that. Now, talking about here about franking deficits tax, and on the next slide about dividends and things that can be payable. Just make sure if you're doing a dividend to make a minimum repayment or generally a dividend from a company throughout the year that there is sufficient franking credits available to do so, because if there isn't, you basically get into this franking deficits tax, and it is quite costly. It's not the best thing to be going down the path of. So just bear that in mind if you don't have enough franking credits available to fully frank a dividend. The general thing that clients are still thinking is available is this loss carryback rule. So what applied in 2013, if you had tax payable, you could take it back and utilise any losses from the prior financial year, being 2012. That has now been repealed, so we can't use that in the 2014 financial year, so that's just a point to note on that. Trusts. Okay, so with trusts, so it's an important time of the year with respect to those. So this is the time of the year where we're all looking at our client base and who's got a trust involved, and we need to do a resolution to determine where the trust income is going to be distributed to. So it's extremely important that you read the deed, and that's why that's in bold right up the top there. We see a lot of occasions that distributions or things have occurred that potentially, they're distributed to beneficiaries that aren't eligible beneficiaries. So you need to just make sure that it is an eligible beneficiary that you're going to be distributing to per the deed. Also making sure that if you're distributing, if you've got a beneficiary there who is under 18 or nearing 18 in this financial year, if you wanted to distribute to them because they've turned 18 in the 2014 financial year, making sure that you've done a tax file number reporting with the tax office. And that's not only applicable to the 18-year-olds, but also any new beneficiary that you're looking to distribute to in the 2014 financial year. You need to make sure that you advise the tax office with via the tax file number reporting rules. So it's probably a good time to start reviewing all your clients who have trusts and starting to get this thing in place now, and you'll probably do that as part of your tax planning because by the time you get the minutes or resolutions out to the clients and back signed prior to 30th of June, it just does take a little bit of time to get those organised. With respect to the meaning of the trust income per the trust deed, be very careful about what that is. So have a look in that deed to work out whether it is you can distribute on accounting or tax, because that's extremely important when you're starting to do your distributions according to that. So I've just spoken about the minor beneficiaries if they're turning 18 before 30th of June 14, so I won't go back into that. When you're working out who's an eligible beneficiary and who you'd like to consider distributing to, be very mindful of the fact of whether that beneficiary could in the future be trying to utilise those small business CGT concessions. So like Paul said earlier, this planning is more to do with, it's not just prior to 30th of June and we're just thinking about tax planning now, but thinking of long-term, not the short-term solution, because there'd be nothing worse than someone distributing to a beneficiary who's looking at utilising those, and then they get taken out because of this distribution that came through to them in prior years. So just be very conscious of that. The trust loss rules also, so if you've got losses carried forward from prior years in the trust that you're trying to utilise against current year profits, you need to be very mindful of whether those, you need to look at those trust loss rules to see if you can offset those losses against current year profits, etc. So they can be quite complex, so you just need to get your head around those and just not automatically assume that you're able to utilise those. If the structure's changed or something's happened throughout the business throughout the year, that could have a big impact on utilising those. The other point to make is just making sure that you've got all your clients as advisors, that you've got the family trust elections and interposed entity elections in place. Consider the test individual, making sure that it is right and it's actually going to achieve what you're wanting to achieve. They're hard to revoke, these things, so once they're in place, they're very hard to get out of. So when you've got your family trust, if you've got any dividends, franking credits or losses, you'll need to be definitely thinking about a family trust election or things like that. So the streaming, so this will come into play as well. So is there an opportunity to stream certain types of income? So you could be looking at, you can only stream really is your capital gains and your franked dividends. However, if you're doing that in this current financial year, you need to, one, make sure that your deed allows you to be able to stream, and two, that your resolution to distribute that income is written accordingly. So to deal with those, you don't want to just a plain resolution to distribute the income. If you are streaming, you need to make sure that you've covered off that accordingly in that trust distribution minute. A CGT event E4, that's basically when it's applicable to unit trust. So if you've got any distributions of non-assessable amounts, just be very mindful of that. That will come into play. So depending if you have any unit trusts where this is applicable, you need to look at that CGT event E4 because there will be an impact of that on it. So with respect to the trusts as well, if you've got you should be quarantining any distributions that you've made to companies in your balance sheet, so separating them out between the unpaid present entitlements that are pre-16 December 2009 and ones that are post. And just bear in mind with those ones with the pre-16 December 2009, making sure that they are solely unpaid present entitlements and they haven't been mixed with loans and things like that. It has to be clearly just a UPE, essentially, that's quarantined for those purposes. Now the ones after the 16th of December 2009, you just need to make sure that are they an actual eligible UPE or do they convert to become a loan at a certain point in time. And that's, again, as I've talked before, is reading the deed, and it will then clarify for you what happens to an unpaid present entitlement if it wasn't paid out, essentially. So you need to make sure that your accounts reflect that. Okay, so superannuation contribution caps. What we've tried to do here is put a table together to make it a bit more clearer or help in understanding, I suppose, where, what contributions are able and limits are able to be applied for certain age groups. So it's not as easy as it has been in prior years. They've got different age levels to determine what contribution is allowed to be put in prior to each financial year. So in that first column you can see that you need to be very mindful it's your age at 30th of June of the prior financial year. So for instance, if we're talking this 2014 financial year and you've got a client who's age 59 at 30th of June 2013, they're eligible for this current financial year to put in $35,000. And accordingly next financial year the same. So just be conscious about that, but it's to do with the prior financial year that you need to look at. Also be conscious of any clients that you've got that you're looking to do planning with that are over the age of 65. So they're only able to contribute into superannuation if they meet a work test. So I've noted that down the bottom there so you can easily see that, but it's basically they need to work 40 hours in 30 consecutive days. So you can split that up, but just as long as it's consecutive. So they could, want to do it in a whole week, or you could split it up to do a number of hours over 30 days. The So hopefully there might be an opportunity as well with respect to those bring forward non-concessional contributions. With the limits going from 150 to 180 and also, sorry, from 450 to 540, there might be an opportunity to put them in after 30th of June 2014, but you need to be very mindful of your client's circumstances, especially if they're over 65, etc.
So Katy, if we've got the family business with grandma and grandpa, and they haven't done anything during the year, but we want to look at putting some money away, we've really got to get them off the lawn bowls and the golf course and get them working in the business now, because we're running out of time to get the 30 days before 30th of June.
Absolutely.
And you have to pass that test before you're able to pay the contribution. So going back to the initial comments, the 27th of June is sort of really the drop dead date when we can pay a contribution, and so we've got to get we've got to get grandma and grandpa or the people above 65 working now so they can get those 40 hours in 30 days before 30th of June.
Absolutely, that's right. Thanks, Paul. So if you've got your clients on pensions within the self-managed superannuation fund, you need to make sure that the minimum amount of pension is drawn prior to 30th of June 2014. So like Paul said, I would be looking at doing that well before the 30th of June, so whether it's on the 27th of June or prior, to make sure that those amounts have been cleared by the self-managed super fund prior to 30th of June 2014. There's severe consequences, as we've noted in that second dot point. If you don't do that and they don't draw that minimum pension, is that it could potentially result in a loss of the pension exemption on the earnings. So you don't want to go down that path. So have a look at those. Now you need to bear in mind too, with the minimums amounts in this current financial year and onwards is stuck at 4%. Maximum is around up to 14%, but that's depending on age, etc. So in previous financial years, however, the government allowed a reduction in the minimum pension, so it was down to 2%. That does not apply then though for this 2014 year onwards. So it's just a good point just to note going forward. Oh, the second slide is basically what I was speaking about before. Hop in early, don't try and do it on the 30th of June because the funds won't be able to be cleared in time for that to occur. This is more on that. Paul discussed the part about the employer side of things. This is more to do with an individual. So if you've got the individuals and you're doing their returns, you might just want to make sure that the employers are paying that correct rate for this current financial year at 9.25%. We've found a lot of clients are potentially looking at their thing and forgetting that actually it was at 9.25% or something down that mark, and then they've had to play a little bit of catch up for that 9.25%. So that's just one for you to check your clients in regards to that. Now the second point is extremely important. So if they're intending to claim a deduction for a superannuation personal contribution in this 014 financial year, you need to make sure that one, looking at that 10% rule test, so as long as 10%, less than 10% of their taxable income is from employment type of income, they may be eligible to claim that personal contribution. But the most important aspect of that is to making sure that they're completing a notice of intent to claim and that you've received that acknowledgement back from the fund. So it's that acknowledgement that you need prior to lodging their return in order for you to be able to claim that personal contribution in their tax return. The medical expenses offset, as I'm sure you're all aware, that's starting to phase out. So the eligibility for that in this current financial year is you need to have out-of-pocket medical expenses of either, depending on your category and your eligibility requirements, is basically 2,120 or the 5,000 mark. So, but you can only claim that though, however, if you did make a claim for the medical expenses offset in the 013 financial year. And that is going forward. So if you do a claim in 014, you then may be eligible in 015. But that could change as well, so you just need to be mindful of that. Also mindful of making sure that they get chemist receipts and things like that. A lot of people just do your Medicare and your private health. However, there's chemist that you could put in there, but it's all stipulated about what's in there and what's not. So you need to be mindful too that if their client's going for some cosmetic surgery, that it's actually covered under a medical specialist. We do see some people that would like to claim things that are for cosmetic purposes only, and they're not to do with under a medical supervision, so bear that one in mind.
So Katie, if I want to break into reality TV and I was going to get some very white teeth, which I think is a prerequisite, and I spent $10,000 doing that, that wouldn't count towards my offset unless my doctor was supervising that.
Absolutely.
Can you cancel the appointment then?
So just check that, because they do come through a bit regularly, and we just do need to talk about that with the client. So bear that in mind when you're speaking to your client on those. So this is more general things that you need to think about with individuals. So prepayment. So looking, is there an opportunity? So for instance, if they had a rental property and things like that, is there a potential for them to claim a prepaying interest on that property? But that'll become part of the tax planning and whether it's required or not, and whether cash flow permits as well. Non-commercial losses, just be mindful of those things. So you need to, there's certain tests involved in being able to claim a loss of a business against other income. Just ticking off on those, there has been a few circumstances where people have tried to claim non-commercial losses against others but failed a couple of those tests, so be mindful of those things. We talk about capital allowance, deduction, and also capital works. You should probably look at, if it's a rental, if they do have a rental property, ensuring that they have got a quantity surveyor report and trying to obtain that extra deduction for them. Looking at their capital allowance and depreciation schedules and seeing can any of the equipment or iPads or the things be written off in this year and they've purchased a new one or something like that. On the, this is just a point to note, just to be mindful of when you're advising your clients, is the 50% general discount is no longer applicable to non-residents as of from the 8th of May 2012. So at that point, if they do have property here, you'll need to make sure that they get a valuation as at that point. However, they're not entitled to be able to claim that general 50% discount going forward. And that is all. So what we've done is we've actually placed our details on the screen.
Now, another reference to the Lego movie where he only works in black and sometimes very, very dark grey. And I think, just tying back to the statement I made at the very beginning, where we've got the budget and the implications of the budget and what's going to get through and not get through. And a good example of some very, very dark grey is one of the initiatives in the budget is the reduction of the company tax rate by 1.5% from the 1st of July 2015. So that's part of the budget. If that doesn't get through all the other bits and pieces, that will not occur. However, though, if you're a business with a taxable income of above $5 million, you'll be required to pay the 1.5% paid parental leave levy. That is law, that is approved. So the perfect storm, or the very, very dark grey, is if the company tax rate doesn't get through and doesn't get reduced from 30% to 28.5%, but you're still stuck with the 1.5% paid parental leave levy for those larger companies. That's probably a very, very dark grey outcome. Similarly, from an individual taxpayer's point of view, the increase in the Medicare levy from 1.5% to 2% from the 1st of July 2014, that is legislation, so that is going to happen. However, though, we've got the 2% high income earners levy, which is all part of the budget, which is supposed to come in 1st of July 2014, which will be applied to people with taxable incomes above $180,000 for 3 years. Now, that is another very, very dark grey outcome in terms of whether clients can restructure their affairs to get below the $180,000 income. And there's been a lot of comment in the media that it only applies to your income above that amount. So I'm not quite sure if someone's a very high earning person for whatever they do, it's going to be very difficult whether they're going to go and lie on the beach for 9 months for the next 3 years and get themselves below that threshold. I don't think that's going to happen. So the very, very dark grey reference is that there's some things that are changing, that are known and not known, or what they're going to end up with. And if the Liberals can't get the current bills through the Senate before 30th of June, when Mr Palmer comes in on the 1st of July, he's his own man and he will make his own decisions on things. So a lot of these things, what starts out as an idea in the lower house and what finally gets passed like in the upper house, is usually very, 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 very dark grey by the end of it. So thank you very much for your attendance today, and I think we're out of time because people have got to get back and meet with their clients to do year-end tax planning, and have a great day.
Thank you.